What if I told you that one of the biggest fears people have in retirement isn't a stock market crash? It's not inflation. It's not even a recession. It's something much simpler and much more personal. It's the fear of waking up one day at 85, 90, or even 95 years old and realizing that the money you worked your entire life to save is running out. Think about that for a moment. Most of us spend decades building wealth. We save consistently, we contribute to retirement plans, we invest through good markets and bad markets. We make sacrifices, we delay gratification. We do all the things financial experts tell us to do. Yet underneath all those smart decisions often sits one lingering question. What if it isn't enough? That's where today's conversation begins. Because while investing is an incredible tool for building wealth, investing alone doesn't solve every retirement challenge. Markets can be unpredictable, interest rates change, economic conditions shift, and perhaps most importantly, none of us knows exactly how long we'll live. That uncertainty creates a unique risk that doesn't exist during our working years. It's called longevity risk. And longevity risk is simply the possibility that you live longer than your money does. Ironically, it's a problem created by success. People are living longer than previous generations. Medical advancements continue to improve quality of life. Many retirees today may spend 25 to 35 years in retirement. That's wonderful news. But it also means your retirement savings may need to work harder and last longer than ever before. Fortunately, there's a financial tool specifically designed to address this challenge. It's called an annuity. Now, I know what some of you are thinking. The moment someone mentions annuities, people tend to fall into one of two camps. Some believe annuities are the greatest retirement invention ever created. Others believe they should be avoided at all costs. The truth, as usual, lives somewhere in the middle. Annuities are neither miracle products nor financial disasters. They're tools. And like any tool, their value depends entirely on how they're used. A hammer is incredibly useful when you're building a house. It's far less useful when you're trying to tighten a screw. The same principle applies to annuities. Used appropriately, they can solve specific retirement problems remarkably well. Used incorrectly, they can create unnecessary complexity, limit flexibility, and potentially cost you money. Today, we're going to cut through the confusion. We'll discuss what annuities really are. We'll explore the 4 major types available today. We'll look at situations where they make sense. We'll examine scenarios where they don't. And most importantly, we'll build a practical decision-making framework that can help you determine whether an annuity belongs anywhere in your own retirement strategy. Let's begin with the foundation. What exactly is an annuity? At its core, an annuity is a contract between you and an insurance company. You provide money, either as a lump sum or through a series of contributions, and in exchange, the insurance company promises certain benefits. Often, those benefits involve guaranteed income. But I think there's a better way to think about annuities. Instead of viewing them as investment products, view them as insurance products. Because that's really what they are. You're purchasing protection. Specifically, protection against the possibility of outliving your money. When people buy homeowners insurance, they aren't hoping their house burns down. When people buy auto insurance, they aren't hoping for a car accident. They're transferring risk. They're paying someone else to absorb a financial risk they don't want to carry themselves. Annuities work the same way. You are transferring longevity risk from yourself to an insurance company. And that transfer can create something incredibly valuable, peace of mind. Now, peace of mind doesn't show up on a spreadsheet. You can't calculate it in a retirement calculator, but it matters. In fact, after working with countless retirees over the years, I've learned something important. Financial success isn't only about maximizing returns. It's about maximizing confidence. It's about helping people sleep well at night. It's about reducing stress. It's about creating a retirement that feels secure, not just one that looks secure on paper. Let me explain what I call the foundation effect. Imagine your monthly essential expenses total $4,000. Housing, utilities, food, insurance, healthcare, the basic necessities. Now imagine that Social Security covers $2,000 of those expenses. A pension covers another $1,000. And an annuity covers the final $1,000. Suddenly, all of your essential needs are covered by guaranteed income, every single month, for life. What happens next is fascinating. Many people become more comfortable investing the rest of their portfolio. Why? Because they no longer depend on every dollar of their investments to survive. Their foundation is already built. Their necessities are protected. Everything else becomes optional spending, lifestyle spending, legacy planning, or growth capital. That psychological shift can be powerful. It changes how people react to market volatility. When the stock market drops 20%, someone relying entirely on investments may panic. Someone whose necessities are covered by guaranteed income often views the same market decline very differently. They have breathing room. They have confidence. They have time. And that's one of the most overlooked benefits annuities can provide. Not higher returns, not market-beating performance, confidence, security, and stability. Now let's talk about the 4 major types of annuities and how each one works. The first category is income annuities. If there is one type of annuity that people should understand first, it's this one. Income annuities are the simplest and in many ways the most powerful. Think of them as personal pensions. You provide a lump sum to an insurance company. In return, the insurance company agrees to pay you income for a specific period or for the rest of your life. That's it. Simple, clean, straightforward. There are 2 primary versions. Immediate annuities begin paying income shortly after you purchase them. Deferred income annuities begin paying income at some future date. The concept is remarkably simple. You trade access to a portion of your money in exchange for guaranteed income. Let's use an example. Imagine a 65-year-old retiree investing $100,000 into an immediate income annuity. In exchange, she receives approximately $635 per month for life, every month. Regardless of what happens in the stock market, regardless of economic conditions, regardless of whether she lives to 75, 85, 95, or beyond, the payments continue. Now here's where things become interesting. If she lives a long life, the insurance company may end up paying far more than the original investment amount. And that's exactly the point. Remember, you're not buying an investment, you're buying insurance. Some people focus solely on whether they'll get their money back. But that's often the wrong question. The better question is, am I protected if I live longer than expected? Because that is the specific risk this product is designed to solve. Of course, there are additional features available. Many contracts offer joint life options for married couples. Some provide period-certain guarantees. Others include death benefit provisions. Each feature can increase protection, but may reduce monthly income. That's the trade-off. More guarantees generally mean slightly smaller payments. Fewer guarantees generally mean larger payments. Neither approach is automatically right or wrong. The best choice depends entirely on your goals. And that's a theme you'll hear repeatedly throughout today's discussion. Financial planning isn't about finding perfect products. It's about finding the right solution for the right problem. The second type of annuity is something called a multi-year guaranteed annuity, often referred to as a MYGA. And honestly, this may be one of the most overlooked financial products available today. A MYGA functions similarly to a certificate of deposit. You agree to leave your money invested for a predetermined period. In exchange, the insurance company guarantees a fixed interest rate. Simple, predictable, easy to understand. The reason MYGAs have gained attention recently is because higher interest rates have dramatically improved their appeal. For years, conservative investors struggled to generate meaningful income. Interest rates were historically low. Safe investments paid very little. Retirees often felt forced to take additional risk simply to generate reasonable returns. That environment has changed, and with higher rates available today, MYGAs have become increasingly competitive compared to traditional savings vehicles. However, there is a catch. Just like a CD, your money is generally committed for a specific period. If you need access early, surrender charges may apply. That's why liquidity planning remains essential. Before purchasing any annuity, You should always ensure you have sufficient emergency reserves and short-term cash needs covered elsewhere. Annuities work best when they're part of a larger strategy, not when they're expected to solve every financial challenge. The third type is the fixed indexed annuity. If income annuities are the easiest to understand, fixed indexed annuities are often the most misunderstood. At first glance, they sound almost too good to be true. You hear phrases like participate in market gains, protected from market losses, never lose money due to market declines. And understandably, many investors immediately become interested. But before anyone signs a contract, it's important to understand exactly how these products work. A fixed indexed annuity is linked to a market index, often the S&P 500. Notice I said linked to the index. I did not say invested directly in the index. That's a very important distinction. When the market rises, your annuity may receive a portion of those gains. However, there are usually limitations. These limitations often come in the form of caps, participation rates, or spreads. For example, let's imagine the market gains 20% during a particular year. You may not receive the full 20%. Instead, the contract might limit your gain to 8%, 9%, or 10%. On the other hand, if the market falls 30%, your return generally doesn't go negative because of market performance. Instead, your return may simply be zero for that period. That's why many retirees find these products appealing. They're not necessarily seeking maximum growth. They're seeking smoother experiences. They're seeking protection. They're seeking a way to participate in some market upside without exposing themselves to the full downside risk of stock ownership. And for certain individuals, that can be a reasonable trade-off. The key is understanding what you're giving up. Nothing in finance comes free. Protection has a cost. In this case, the cost is often reduced upside potential. You are sacrificing some gains in exchange for limiting losses. For some retirees, that's exactly what they want. For others, particularly younger investors with long time horizons, it may not be the best fit. Again, context matters, goals matter, personal preferences matter. The fourth and final category is variable annuities, and this is where I encourage investors to proceed carefully. Variable annuities typically allow money to be invested in market-based subaccounts that function somewhat similarly to mutual funds. Unlike fixed annuities, your returns fluctuate based on investment performance. If the market performs well, your account may grow substantially. If the market performs poorly, your account value may decline. Now, that alone isn't necessarily a problem. After all, that's how investing works. The challenge often lies in the cost structure. Many variable annuities carry layers of fees: mortality expenses, administrative fees, investment management fees, optional rider costs. When added together, it's not uncommon to see total annual expenses exceed 2% or even 3%. That may not sound significant at first, but over a retirement lasting decades, those fees can have an enormous impact. Imagine two portfolios earning identical market returns. One pays 0.25% annually in expenses. The other pays 3%. Fast forward 20 years and the difference can be staggering, hundreds of thousands of dollars, sometimes more. That's why variable annuities require careful analysis. I'm not saying they never make sense. There are situations where certain guarantees may justify the cost, but investors should fully understand what they're paying for and whether less expensive alternatives exist. Too often, people focus on the sales presentation without fully evaluating the long-term implications. And that's where mistakes happen. Now let's talk about something that many people completely overlook when evaluating annuities: interest rates. Interest rates change everything. In fact, they can dramatically affect whether an annuity is attractive or unattractive at any given moment. Think about it this way. Insurance companies don't simply place your money in a vault, they invest it. A significant portion often goes into high-quality bonds and other fixed-income investments. The returns generated from those investments help fund future annuity payments. When interest rates are low, insurance companies earn less. When insurance companies earn less, annuity payouts tend to be lower. When interest rates rise, the opposite happens. Insurance companies can earn more. As a result, they can often offer more attractive payouts. This is one reason annuity conversations have become more relevant in recent years. The environment today looks dramatically different than it did several years ago. There was a period when retirees faced a difficult challenge. Safe investments generated very little income. Certificates of deposit paid almost nothing. Government bonds offered limited yields. Conservative investors found themselves squeezed. Today, the landscape is different. Higher interest rates have improved payout structures across many annuity products. That doesn't automatically mean everyone should rush out and buy one, but it does mean the math is often more favorable than it was during the low-rate years. And timing matters. The same annuity purchased in different interest rate environments may produce dramatically different outcomes. That's why evaluating current market conditions should always be part of the decision-making process. Now let's shift our attention to a question that sophisticated investors often ask. How should annuities fit into an overall portfolio? This is where many people make a critical mistake. They view annuities separately from the rest of their assets. But that's not how financial planning works. Everything should be evaluated together. Let's imagine you receive $2,500 per month from a pension. You might not think of that pension as an investment asset, but financially speaking, it absolutely has value. In fact, if someone needed to purchase an income stream equivalent to that pension today, it could require hundreds of thousands of dollars. The same concept applies to annuities. Guaranteed lifetime income has economic value, and that value should be incorporated into your broader retirement plan. I once worked with a retiree who received approximately $3,000 per month from a pension. Initially, he viewed himself as an extremely conservative investor. He worried constantly about market declines. He kept much of his portfolio in low-growth investments because he feared running out of money. But after evaluating the replacement value of his pension, something became clear. His pension represented an asset worth hundreds of thousands of dollars. Essentially, he already had a substantial fixed income position built into his financial life. Once he understood that, his perspective changed. He realized his investment portfolio didn't need to carry the entire burden of providing security. The pension was already doing much of that work. As a result, he was able to invest other assets more efficiently and pursue long-term growth opportunities with greater confidence. That's why understanding the full picture matters. Retirement planning isn't about individual products. It's about creating a system. Each piece should support the others. Now let's discuss taxes, because taxes can significantly influence annuity outcomes. And unfortunately, this is another area where many investors overlook important details. The tax treatment depends largely on where the money comes from. If you purchase an annuity using pre-tax retirement funds, such as a traditional IRA or traditional 401k, distributions are generally taxed as ordinary income. This shouldn't be surprising because those funds haven't been taxed yet. Eventually, taxes become due. However, if you purchase an annuity using after-tax dollars from a non-retirement account, the taxation works differently. Part of each payment represents a return of your original principal. That portion is generally not taxed again. The earnings portion, however, remains taxable. This creates what's known as an exclusion ratio, which determines how payments are treated for tax purposes. The details can become complex, which is why professional guidance often proves valuable. Because the best annuity isn't simply the one with the highest payout, it's the one that delivers the best after-tax outcome for your specific situation. Now let's talk about the situations where annuities truly shine. Because despite all the controversy surrounding these products, there are circumstances where they solve very real problems. The first is what I call the sleep-at-night factor. And I don't mean that casually. Financial anxiety is real. Market volatility affects people differently. Some investors can watch their portfolio decline 25% and remain perfectly calm. Others lose sleep over a 5% drop. Neither reaction is right or wrong. It's simply human nature. I remember speaking with a retiree who had accumulated nearly $800,000 in retirement savings. Objectively, she was in excellent shape financially. Yet every market decline created enormous stress. Every news headline felt threatening. Every downturn felt catastrophic. The issue wasn't math. The issue was confidence. By allocating a portion of her savings toward guaranteed income that covered her essential expenses, everything changed. Suddenly, she wasn't watching market movements every day. She wasn't constantly checking account balances. She wasn't living in fear. Her financial situation hadn't changed dramatically, but her emotional experience had, and that improvement mattered. Because a retirement plan that looks great on paper but creates constant anxiety isn't truly successful. A successful retirement should support both financial health and emotional well-being. The second scenario involves what I call the pension gap. Many previous generations retired with pensions. Today's workers often don't. Instead, they carry the responsibility of creating their own retirement income. For professionals who have accumulated substantial assets but lack guaranteed income sources, certain annuity strategies can help fill that gap. In effect, they're creating a personal pension where none previously existed. And for some individuals, that added stability can provide tremendous value.